No, but today, I think this is something that I want to touch base with you guys, and I think it was like a perfect masterclass. Daisy's the one that got this all set up, and it's all about the money, because of course, we all don't have sales yet, right? But we are about to have sales, and if you're not thinking you're about to have a whole bunch of sales, you're thinking the wrong way. You got to have that mindset of damn, I am going to need to do my taxes the right way. I am going to need to have expenses the right way. You got to think future, right? I would say, what are your thoughts? For those that are just getting started or maybe don't have all the sales, that you want yet, if you only have 2 or 3 sales, taxes and money don't really matter too much, right? But for those of you guys that started, the last 6 months, or even we're going to even go to different levels as far as, agents that are doing $200,000, $300,000 take home, that's when you really start to need to know what you're doing with your money and with your taxes and all that good stuff. Because the thing is, what's going to happen is you're going to get hit by the end of the year and get a big tax bill, and you're going to be like, what the hell, I wish I did this better. And I was, when I first started my career, I was an agent on a team for a long time, and being an agent on a team, you have a lot of sales, you guys are 1099, this is your own business. This is your business within a business within a business, and so I think if you do it the right way from the beginning, that's, you're going to set yourself up for, just being better and better, as you grow and you become, you start making a lot of money, and then you're like, okay, now I can start really making some cool moves, right? Buying vehicles and stuff. But I mean, to get started, I didn't know what the hell I was doing. I was just trying to sell houses. And I was trying to make money, and I was going on vacations, and I was like, yeah, this is tight. And then at the end of the year, I realized, I was like, oh, this is a tax bill that I owe a lot of taxes back. And then that's when, I was using QuickBooks or, one of those, I was using TurboTax and, stuff like that. That's, I didn't know what I was doing, right? And I started making all this money. And then that's when I started getting these big tax bills. I would say, I don't know, 2 years in a row, probably my first, the first year I didn't close as many to be able to worry too much about the taxes. But the second year, the third year, and I would say almost the fourth year, I was stuck with a tax bill that I couldn't pay. Because you spend your money that you make. I wasn't saving, I wasn't investing. I was, we kind of spend it before we actually get it, kind of thing, right? So I think by the time, I was on payments for a long time. And what happens is they'll let you not pay, but you're going to have to pay fines and fees, and they tack on to what you owe them. And then you have these payment plans, and these payment plans will stick with you forever until you pay them. And so I was on those for quite a few years. And that's when I was like, what, I can't do this. What the hell? I'm paying every single month to the tax person. And it was crazy. I was like, what the hell? And so then we finally found a tax guy. And I was like, oh man, this dude graduated from Cal, hella smart, does real estate as well. He knows what he's doing. Started working with this guy, and I didn't know what I was doing. So basically, he was just telling us okay, we'll do this and do this. But it was more so of he was almost like the TurboTax, and just making sure that we weren't going to get audited and all that other stuff. But come to find out, we were still owing 6 figures. That was our bill, was over 6 figures a year for I would say 2 to 3 years. We were paying over 6 figures every year just in taxes. And when you get hit with that tax bill and it's $100,000, $120,000, $140,000, which what were my tax bills, $90,000, I was like, what the hell? I don't have this much money. Because you got bills and you're paying income and, the expenses and stuff like that. And so I think that's where it's so important, because when you get hit with those, they stack up. And then I think I was probably on a payment plan, I don't know, there was 2 years, I think, put together total, and I was paying on those. And so I think that's where the thing for me is really just, I didn't know what to do. I didn't know the tips and tricks. I didn't have anybody that really showed us, where to go, what to do. Because my wife had her thing going, I had my wife thing going, we were killing it, we were crushing it in business. But then at the end of the year, it was always a scramble. We didn't have our books together. We didn't have the right accounting. We didn't have, we were just kind of printing all of the bank statements and then spending hours and hours and hours, if not, weeks, 2 weeks of just going through bank statements and trying to filter, okay, what's an expense? What's an income? What's an expense? And so, we started getting a little smarter, but I think that what I learned is what you pay is what you get, right? And who you choose to help you financially with your taxes and to help you with your money is the biggest thing, because there are so many things that we probably could have done that would have saved me so much more that, who knows, I probably could have got another investment property, or I could have got some other things. We could have went on even bigger vacations with the money that we were saving. So that's just kind of talking about that, about how just learning from those experiences. And that's what I want to be able to make sure we pass on to you guys, because you guys, dude, some of you guys are starting to roll. You guys are starting to make a lot of money, and you guys are going to start to hit 100,000, 200,000. Like, you guys sell 15 homes this year. You guys are going to make at least $150,000 take home after, splits and everything. Like, you guys start to hit 20, you're going to be hitting 20 to 25 sales is over $200,000. Like, that's a lot of money. You're rolling. Like, and then you kind of start to learn how to make 300,000 and 350. And then now that's when you're going to be able to start buying investment properties and stuff like that. So the more money you guys have in your pocket at the end of the year, you're going to be able to buy that investment property with that money that instead of paying Uncle Sam, you could have used that, right? So, because sometimes it makes a difference. Like, you need 20%, 25% down. Like, sometimes you need that extra 30,000, 40,000, 50,000 that you could potentially save. So where I'm going with this is, like, we hired the wrong guy, and this guy cost us a lot of money. I didn't know any tips or tricks. He didn't tell me to do any tips or tricks. And then, like, this was probably during, I don't know, COVID time or somewhere, 5 years ago, 4 years ago, when I was like, all right, we need to find another guy because we keep paying way too much in taxes. And so that's when we started calling around. Like, you try to pick up and call tax people right now, like, nobody's going to take your business. Like, nobody wanted to, like, pick up. They weren't even returning my calls, right? Like, so I think that's where it's like, get started early. Like, get started not during tax time and try to get your taxes and build relationships. If Mauricio or not, like, I think that's what I learned also is, like, you got to get started with your 2025 taxes kind of like now, and start that communication and start, finding that right relationship, right, with that person that you're going to be working with. But for me, I needed somebody that was like, dude, tell me what I need to do. Like, what do I need to do? Like, what are some of the strategies? What are some of the tips? What are some of the advices? The moves that I can make to save money and not have to pay this much in taxes. And that's where finding Mauricio over here, like this guy, like, I don't know, last year I think we paid
very little.
I don't know, $20,000, $30,000 in taxes. When there's prior years where I was, like I said, six figures. Like, I think one of our biggest tax bill was $120,000, $130,000. Right? So I think that's where it's like learning that kind of stuff, where it's like, okay, now we're investing it into HSE funds or, the accounts, and, like, these Roth RIAs, and buying vehicles that are going to be tax write-offs, like all of these different things. Like, I was able to buy my brand new vehicle for the first time ever 3 years ago. I was on leases, lease. So the Denali that I have now is my first brand new vehicle that I've ever purchased, and it's all write-off. So I'm not even paying for it. But it's like learning the tips and tricks, and I think that's where having you guys be able to learn everything from start to finish. No matter how many sales you guys are doing, you guys could always pick something up. Another quick story happened a couple months ago, where I went to EXPCon, and they did a mastermind with our EXP group, and Kyle Whistle went up there, and he was talking about all these tax savings and all this other stuff. And then he was like, man, if you guys aren't doing this, or if your tax guy is not doing any of these things, you need to fire him. You don't have the right tax guy. So I'm over here texting Mauricio at the conference. I'm like, hey man, are we doing this? Hey, are we doing this? Hey, are we doing this? And he's like, yeah, we're doing that one. Yeah, we're doing that one. I was like, okay, I got the right guy.
In my head, I'm like, yeah, we've been doing that a while now.
Like, randomly just popping up some random questions. Yeah. Like, I'm in Miami at a conference room, and he's probably doing something else. And then he responded right away. So that was like, but that was cool though. But it's like that confirmation of, like, like a lot of us use Mauricio now for our taxes, books. He does a lot of the finances stuff, for our team now. He's been coming in talking to us. So I think it's good to have him come in beginning of the year so you guys can start fresh and get organized now. So then at the end of the year, you're not struggling and trying to figure everything out. Like it's already kind of organized, ready to go. It's kind of just like your leads in a database, like you start fresh, like now you could organize your people, right? It's a little more cleaner to start the year. So that's it. I want to introduce Mauricio over here. And yeah, man, I'm gonna let you take it.
Yeah.
Take the stage, man.
Hey guys, so how many of you are new right now to the EXP team? Okay, let me introduce myself. You guys, I've been in the tax space now for I think 18 years. Just like you guys, start off in the business. Like anything else, you have to learn it. You don't teach you a lot of stuff in school. Everyone knows that now, right? As my business kept growing, I kept taking more classes, how to save on taxes, became an enrolled agent. I wasn't supposed to go into the tax world. I was supposed to go into a different field. I was an economics major, so that helps out with business clients. When I talk to business clients, because I do a lot of forecasting, that's what I used to do before on the economic side of things. So that actually helps me relate better with a business client. If you're opening a restaurant, a realtor, all these numbers just go through my head and it just starts giving out output to clients. Been here in Pinole now for 7, 8, 10 years, 15. I lost track. But every year I keep taking classes. I never stop trying to learn how I can save my clients on taxes. Now, everyone's at a different field right now, right? A different phase in their real estate career, right? So I like to start with intro, middle, and then whoever's there, because whoever's in the intro side, then you'll be able to hear what you need to do when you're growing to get to that next side. So for the people just starting off, just the basics. Just keep in mind the basics. You guys drive a lot. Let's be realistic. You guys drive a lot. The keeping track is huge. Mile IQ, it's like $10 a month. I've gotten through an audit with a client with that, they don't question it. So if you have a Mile IQ app and you track it through there, they'll accept that as your mileage. If oil changes, it's really tough. Depends on if we ever go through it. I try to avoid audits altogether, meaning when I do a client's taxes, I tell the client, hey, keep it at this realm here and we won't have any issues. If you want to go further, that's fine. Just keep in mind that you better have your receipts in order, like everything in order. If everything's in order, then let's go. If not, then keep it there. Mile IQ, you're separating your personal and your business accounts. That's huge because then you don't know what's what. You're going to be like, they start off, they're going through your bank statements. What was personal, what's not. Don't give it to me. If you give it to me, I'm just going to send you a big bill because it's a lot of tedious work. I try to tell my clients to start off, hey, try to avoid a lot of expenses, right? So if you guys just starting off, the only thing I can give you on the business side of things, forget taxes right now, just avoid a lot of expenses because that you need to invest back in your business. You can put it back into marketing, taking more classes, whatever the case may be. As you grow, then eventually there'll come a time where, okay, I'm ready to spend some money on some things I need to do, bookkeeping, tax planning. But for the beginning, just make sure, just keep making money. 101, money helps you out a lot. You make money, it helps pay me, right? I mean, realistically, pays your advertisement, who's on the Google ads, Yelp ads, whatever the case may be, flyers, who's sending out flyers to their clients. So all that goes back into your business, which then should give you an ROI, something back in return. We're spending a lot of money on software nowadays. I see that a lot. Contact with your clients, your past clients, whatever you do today will come back year 5 or year 7. So average, they say in real estate, they buy and sell a home every 7 years. It could be changing due to the higher rates and people not wanting to move because of the lower rates, but average is 7 years. After that, they go back to whoever helped them, then that's why you're in contact with them. Little yearly postcard, always stay in their faces. Just recommend that highly. Then at year 7, if you've been doing this right, you're stable. Meaning, I have a realtor who says, I've been at this for 10 years. I'm like, in my head, I'm like, okay, you should be at X amount. If they're not, then they're not doing something right. He's got a very, very good system. If you just follow that, you can't go wrong. Very simple. Want to lose weight? Do this. Want to make money? Just do this. He'll just do this and you'll make money in real estate. So simple. Then when you start off, just follow the steps. Know that you have people there to help and guide you. Hey, I did X amount. Maybe I should go see Mauricio now. Maybe not. I remember what he said in a training. Sometimes people hit me up month 6, month 7 after talking to the group. It depends on when you're ready for that. So just keep in mind, if your mileage is huge for real estate, I mean, right, you guys should be putting in over 20,000 miles average. Anyone? Yeah? No? Yeah? 25? I mean, right? I mean, easy. If I see a realtor come in, I'm like, hey, first thing I know that I can use a big deduction, big business expense is your mileage. That's the biggest #1 thing. And that's the next thing I ask, are you spending money on advertisement? Where are you at? Where your final number's at? If you're having a good year, please plan ahead. I can't stress that enough. December 31st closes, I can't go back. I mean, I can't go say, hey, you have X amount, go purchase this to lower your tax bill, do this. It's too late. So if you, by November, if you know your X amount income-wise, you better start looking at it and be like, okay, let me see where I'm at before you take that extravagant vacation, which we need it for taxes, you know, like, because that's our December, right? Everyone spends money in December. Who didn't spend money this December? Who didn't go somewhere, gifts, Christmas gifts, and you have New Year's and whatever the case may be, and the money you had saved up, you spent it, so let's know where your tax liability is going to be at. If you're also doing very well, then we have then the middle group, then we're going to start talking about making sure we send some quarterly payments out. If you're netting 70,000 after expenses, that's when you need to mentally switch yourself to a corporation. 70K and above. If you brought in 100 after expenses, I can probably drop you down to 30. Honestly, that should be no problem. But if you're netting over 70, so after expenses, you're netting 70 constantly, first thing I'm going to tell you is, hey, switch to an S Corp. Do it or not, that's up to you. I had a client that for 2 years, he goes, no, I'm not going to make this much. Like, it's your second year. All right, go ahead. Here's your tax bill. He paid it. Third year. All right, I'm going to make it again. Yes, switch. So finally switched, and he's saving a lot on taxes now. So the S Corporation, if you guys don't know, is for small business owners. You guys are considered small business owners. It's literally written into IRS code to help small business owners save on taxes. If they save money on taxes, you then invest it back into the economy, whether it's you're going to hire someone, you're going to buy vehicles, equipment, whatever the case may be. You save it, you spend it, it goes back into the economy. So it helps the economy move and flow. So that's your 70K mark. And then above that, then we're talking about other items. We're talking about, you know, your monthly meetings through your S Corp. You can have up to 14 meetings at your home as long as you don't have the same address. So I always tell them, have a different business address and then have your home address, and then you can rent your house out to your corporation. The Augusta rule, 14 times out of the year. That's your max. That was in place for when there's a special event, the Olympics come into town, and you just want to move out, rent your place out for like a week or so, and then get that money. It's not a true rental. They let you do that tax-free, so you can exclude part of your income there. If you have kids, you know, you can start paying your kids technically. That's a little tricky sometimes. Over age 12 is no issue. Under 12, to be just make sure that they do something, write it down, you know, document whatever they're going to do for the business, and you can pay your kids. So if your tax rate keeps going up, then we start trying to bring it down. We just work on it. So then we have our entry. I just need you to just make money, keep track of your car miles that you do, your expenses on what you're doing. And then as you're growing, then I tell everyone, hey, you got steps to this. I can't give you everything at once, because once you hit step 1, you're going to retain that information, and then step 2, you retain it, and so on and so on. And then by this phase here, you're already knowing the lingo, the language of when we talk about taxes. I want to ask you guys have any questions for me?
Yeah, so for tracking mileage, do you recommend saving like gas receipts?
No, gas receipts doesn't prove anything. Just shows that you purchase gas. What they want to see is like a log So when I was in banking, if I had to go visit a client, I literally had to put what my mileage were and then calculate the amount I would get reimbursed for it. So that's why they either like a log, a log or Mile IQ. Now, bad news is if you drive in and this is your office, this is not considered a business expense. Just keep that in mind. This is just your regular commute, not a business expense. If you're going out with clients, that is 100% right off the mileage. Now, you have two options here. You can keep track of the receipts, right? All your gas receipts or the mileage. The mileage gives you a higher deduction. Embedded in it will be your wear and tear of the car. Okay, so keep that in mind too. So I always like to go for the miles if we can. And it just keeps that embedded in there. It gives you a higher business expense.
What about like travel expenses if you're taking a flight to like a conference?
No, conferences are no problem. You see, I had a client who got audited. We went to the IRS office. He had a receipt for Southwest. I call him up. What's this for? Oh, it's my parents' flight. Okay, it was too late because that's what we presented. And I said I wasn't going to fight it, but they want to say, okay, where'd you go? What was the conference? If you have a conference, print out the conference that you're going to. So usually when I do a conference in Vegas or I'll go to Florida, I print out my conference, then I'll attach everything to it like a small little expense sheet, and then that's my proof that I went to the conference. And I have my stack like this of my own personal receipts. So the better you keep track, the less issues you have. Just keep that in mind. The better you keep track. Now, for my first tier people, it's not that bad. So, meaning the likelihood of you being audited is not that high because basically there's an algorithm that says how much you made to what's going to cost us to audit you, right? They're going to be like, it's not enough. It's just, I'll be honest. I'm 100% honest with everyone. So it's not enough. So if I see you coming into my office, I could be more relaxed with you. Like, okay, I don't need, I'm kind of relaxed. Middle, I'm a little bit like, hey, make sure you have your receipts. Like, hey, get ready because it's going to come. Top, if you don't have your receipts, forget about it. We're going to go through an audit. Hey, your income is getting high. Get ready. Let's get the books in order. Now this is when I tell them, hey, pay for the bookkeeping because you're going to need it. The bookkeeping helps because that's certified saying these were my business expenses.
What's the X amount of, let's say, I think a lot of us are new on the team, so let's say if you're making like 2 transactions for your first year and your commission checks come in 15 and 15, so 30,000.
I'm not worried.
Yeah, how much would you save?
100K and above.
Huh?
100K.
Okay.
The first tier, anything over, once you get a 1099 issued for $100,000 and above, the algorithm the IRS has automatically says your likelihood of an audit is higher. They know that you're going to fudge a little bit more on your taxes, so they know if they catch you on one item, they're going to ask you for receipts on everything. If you can't provide the receipts, they can just take back some of your expenses and give you a big tax bill. They'll on 100K, you're looking at a tax bill. If you net 100K, 30 or 35, something like that. On the federal side, then you have the state. Rough number. I have a big stack.
I use an app where I just have my receipt printed out, take a photo,
Perfect.
email it in. Does that work equally as well, or do you always recommend keeping it out?
IRS is still old school, but they're starting to slowly change. So if you do that and you put a note on it, they'll accept it. The act of you going above and beyond, taking the picture, putting a note. I literally ran into a client at the coffee house, right? Ran into her, paid for the coffee that we had a quick little meeting. I said, hey, I actually said, I have to apologize to you. Why? I'm going to leave as soon as my coffee's out. Like, what do you mean? I got a meeting. I'm letting you know ahead of time. I'm not trying to be rude. Okay. So we talked real quick, and then I have a digital receipt. So technically, I have to go in there and put who I had this coffee with to justify the business expense. Because right now, everything's right. The app, just pay. So that's what you have to do is like put a note on. That's why the paper receipts were important because you would put, I had a name, sir? Your name? Jaden. I had lunch with Jaden, talked about so-and-so. That's what they like. They love that, because that shows that we had lunch and we talked about business. It's a business expense, right? And then you have on the meal side, you have your 50-50, meaning if Jaden and I go out, it's a 50-50. You can't expense the whole amount. Not 100%, because they say, well, I had to have lunch. I get that a lot. Like, if you were working, not working, would you still have lunch? Yeah, okay, then there you go. So if you're not working, would you still eat? You're still gonna eat. So that's how they see it. So then just keep that in mind. So if you just say, oh, it's because I'm having lunch or dinner. Now, this is a group event. Now, this is 100%. He's sponsoring the event. It's documented. Everyone's here. Coffee is a write-off. Donuts are a write-off. So if he wants to order some steak for lunch, that's a write-off. If he wants steak for us for lunch, so that's right. Just letting you know. Just throwing that out there. He can expense the whole meal. That's 100% write-off. Yes. That's a good question, and I'll let you know how they view it. No, the problem is that when you print out your business bank account, they don't know what it's for. It just says transaction XYZ place dollar amount. So you then have to say, hey, what this is for. Then that's where the receipt comes into play. So let's look at a typical bank statement, right? Transaction, 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 transaction. Okay, now on so the IRS has a code. Every business has a code. If you're a realtor, they know what your expenses are typically going to be. Contractors, that's why they have a code. If you've ever opened your bank account, business bank account, first thing they ask you is, what do you do? The agent, or whatever the case may be, will look up your code to put it, and so it lets the bank know what your volume and transactions are going to be like. Hey, I have a restaurant. Oh, we know this client's going to bring in a lot of cash. Restaurants, I know this guy's going to buy a lot of food, because he's a restaurant. Realtors, what's your biggest expense? Like I said, the car is the biggest. If you do a lot of advertisement to bring in the business, then the rest, you just have a higher tax bill, because literally you are the business, right? You're not paying for food. You're the best business to be in. You don't have to worry about inventory, food going bad. What my restaurant guys suffer, their margins are so small in restaurants. I mean, this is really a good business to go to. Second part.
Second part, you mentioned keep your expenses or don't avoid a lot of expenses. Is there a general number wise that realtors should kind of be mindful about when it comes to their expenses, or certain things? Like I think about like our associations, co-op fees, and all that other stuff they include, along with like our car notes and stuff too. I know you mentioned if you work from home or you have office at home to a separate address. I know sometimes, or at least I've heard, if you've got like a designated room in your house that you're operating out of to do business, how else do you incorporate that too into, I guess, tracking your expenses and how you calculate how that expense works, what is where?
Let me understand. So first you asked if not to spend so much, right? And then okay, so I think I get what you're asking. First is, what I mean by that is when you first start in the business, you don't need bookkeeping. I like to be honest with people. Hey, you come into me like right now you don't need the bookkeeping services, save the money there. Spend it on advertisement. There's some hard costs that you have. You're gonna have your DRE fees, I believe. Right, so those are hard costs, right? You can't get around that. Your advertisement, you should not try to save money on that either, because that brings it. So there's a hard cost to anything, and then there's your tangibles, like, okay, do I really need to spend money on this right now? I try to tell my clients, save money on certain items to spend it wisely in the business. So what's a good expense for you? Advertising, right? You get your name out, mailers. I've heard, right, we go door knocking, try to get our name out there more. So that's going to be a good expense compared to like, hey, I just started off, Mauricio, let me sign up for your bookkeeping services. I don't feel right. I'll be like, hey, look, I'm going to bill you X amount. I don't want to do that to you. I don't want you signing up for things that you don't need just yet. Like, hey, I'm going to need it, but let me get to this level here, and then I know I'm going to need it. That's what I mean by that.
Okay, so just don't jump off the deep end with all the unnecessary things for your business and then try to write it off because it's probably
You need the cash. Hey, you need the money, right? We gotta feed ourselves. We gotta pay for certain things. Let's not try to just spend money yet. Now, that's for the first tier. Then you have the second tier, and then you have your, I call it the third tier of where you're at in your careers. Yes.
I guess I would start off with, is IRS looking at our GCI, I'm assuming, or what we're taking home?
Your gross, what comes in. So that's what, they have different tiers, right? Even the same thing.
It's your net. It would be your 1099.
Yeah, not your net. Yeah, what came in. So like if you got a 1099 for 50,000, I'm not worried. 1099 for 120, okay, hey, I then have the conversation with the client, like, hey, look, you got to get more in order. Because sometimes when you're in it, meaning you're just generating, you're selling, you're not thinking about it. And next thing you know, I made how much? I didn't realize it. And you weren't prepared. You weren't ready for it. Then you get the big tax bill. Then you're like, oh man, and I just went to El Salvador and just spent X amount. And then come April, here's your bill. Thanks, Mauricio. I'm like, what'd I do? I didn't do nothing. But here's your bill. And you're like, oh, how do I pay for this? Okay, let me go back to sales, right? Let me go. So, but don't forget, the sale that you did, you owe taxes on. So it's not all your net. That's where I call it, you're just digging the hole a little bit deeper and a little bit deeper.
And then when you said about keeping separate business and personal, obviously meals, if you're taking a client out for coffee or whatever, but if you're going on a personal, like you're eating lunch, you should probably not use that same.
100% don't use it. It makes it easier for you, because at the end of the year, you're going to have to, okay, what was what? Now, on our end, when we do clients' books, we usually go through it and we try to educate the client too. Hey, what is this? Is it a business meal, not a business meal? So we usually try to talk to our clients to let them know to keep the two separate. Otherwise, it just makes bookkeeping like a nightmare. It's really tough. Yes, sir.
But I thought you have to print out the receipts because the statements are enough, right? So
Statements are not enough.
So it doesn't matter what card you use.
But it helps on your end. So let's say you have 4 different cards and you're using 4 different cards. Now you got to go through what's what. You're like, okay, well, I knew I took someone out in October. Where is that? Which receipt? Where was it? Where is it? That one, if you just use that one card, I like a credit card, just so we know, not a debit card, that one credit card for everything, but make sure you pay it, just be clear. Pay it, use it, pay it. And you keep that one, it makes your life easier. Like, it just keeps you in that first habit of just keeping it clean. And it lets you know too, like, okay, am I spending too much? Dude, I've taken a lot of clients out, but I got no business back. Hold up here, I'm doing something wrong. I took out X amount of clients, great. I didn't get no one to sign my agreement, not great. So that helps you too. I feel those numbers should help you too, like to make decisions too, right? Because everyone here is independent. Everyone here has their own business. So then how do you run your own business? You're a little bit of everything. When I started, I was like washing my windows. I was cleaning the floors. I was a janitor. I was picking up the phone calls, setting my own appointments. You're doing the same thing, right? People call you, pick up the phone. Home office, well, you got to clean your own home office, hopefully, et cetera, et cetera. So you kind of take all the roles in the beginning until you can then grow. Then you're like, hey, let me delegate this role to someone else. Anybody to help me out with the books. I'm ready for it now. Perfect. Now you don't have to worry about that, and that helps you focus now on the business. So that's where my middle and my top tier is what I always try to tell them, hey, eventually try to delegate some things so it just focuses on business. Yes?
Okay, last question. Say you make less than 70,000 on the real estate side, but you have income coming in from some other kind of job.
Okay. You hit over 100, then it's you go back to the same.
Okay, so but do you follow them together, or
yes.
do you add them together, or?
Yeah. So then, new to real estate.
I mean, you're doing real estate the right way.
Okay. I love that. So you're gonna have your tax return. Everyone files a 1040 on the individual side. I'm not talking companies here. You have your W-2 income. I worked at XYZ company, 65,000, perfect. Then within it, it's gonna, the forms change all the time. Right now it's gonna say other income, but that should be your business income, and it just shows your net. So your front page only shows your net. Within your tax return, it'll show your actual how much came in, and that's what they see. And then that's how you get kind of graded by the IRS, if you want to call it a grade. Yes?
So when the IRS, like,
what do they want to see with regards to mileage? Just like to and from and miles? That's it?
That's it.
Okay.
To and from what, like why?
Yeah.
Why do you, oh, I went to go show these clients this home. Oh, okay. I had to drive to, what's the furthest you've gone?
Woodland.
Oh, good Lord. That's a, you know, like, hey, I had to drive to Woodland, then drive back. That's a whole 100%, right? Okay, what'd you go to Woodland for? Well, I went to go see a house. So sometimes when you do that little note, that's what it's for. That's why the Mile IQ, if you just, at the end of the night, it just tells you everywhere you drove, because it's working on your phone on the back end, and you just swipe it, business, not business. This was Target, that wasn't business. I just went to Target to pick up some house supplies. Okay, no, this is business. So that's what the Mile IQ does for you. That's all. It's really simple, easy, and you don't get questioned with it. That's what I like about it, is that I know that if you have the Mile IQ, you have a roofer. 65,000 miles is what he averages a year. He's in Sacramento. 65,000 miles. I'm like, good Lord, that's his, just that expense alone is huge. But he has a Mile IQ, so I don't mind. He drives more than Uber drivers.
Yeah. So do they want to specifically see like the averages that you went to?
No.
Okay.
They just want to know if it was for business or not. When we put the realtor code, they'll know that you drive a lot. That's what that is for. Now, for me, they would question more my mileage, because I'm like, okay, what do you mean? You're going where? You're a tax professional. You should mainly be in your office, right? So so then we go back to the code that you put on your return. On your return, there's a code. Whoever's doing your taxes. Right? So what do? Okay, then we got to look up the code and put it in there, and that's what that helps the IRS know. So then the IRS has a computer algorithm, says this code on average should be this. So sometimes when I see clients, if it's not real estate, anything else, I'm like, hey, your numbers don't add up to me. What do you mean? Look, I saw what you brought in, I see what you're netting. Just look, we got to switch it. I don't need to know if you make cash on the side. That's not what I'm asking. I'm just letting you know, numbers don't add up. You know, because I know that the system will flag it. So they're like, okay, you're right, it doesn't add up. Yeah.
It's kind of a two-in-one question. The business model will account for to and from, back home, and to.
Okay, repeat that again.
Would the business model account for to and from the location?
Yes.
The second one is, this might be a niche scenario, but say you go out, show a client a home, but you stop by, let's say Target, to do a personal run. Will the business mileage still count? After
Should, because your initial intent was to go to the business, and on the way back, you just happen to stop. Still the same amount to come back. Now, if you come home, go there, come home, and then go to Target, then no. That's why we want to go to Target in between, and then go home. Yes, I agree with you.
Yeah.
And if, like, say you're part of the team, is this then a hub where you start from, so pretty much like say you go from home to office, that doesn't count, right?
Technically, it does not, 100%. So they have a ruling on that, like that's just your regular commute. Anyone who just has a regular location that they have an office at, that doesn't count.
But if it's from like here, showing back, then that's.
Boom, yes. So if you live down the street, my first 5 miles didn't count, but then after that, I drove around 30 miles because I then went to Richmond. I went to Point Richmond, then I came back to Hercules to show another home. Then a client called me, hey, can you come by? I'm thinking about selling my home in Vallejo. Then you got the toll bridge in plus the Vallejo expense. And anyone else?
Yeah, one thing that they should teach and have, like the moment you get your final exam and you pass it, and it's like they should have a checklist, right? Of like, okay, you just started a business, now do these business things. Because like when you start a corporation, there's like a checklist that you have to do of all these things. And I think that's one of the things that they need to have for when you get your real estate license. They need to have like this checklist. Because I think, so like what are, the checklist that, actionable items that they need to be able to, like, let's say the license is there. What are like the first things they need? Like, I think that comes to my mind that was the most easiest is just going to open up a regular checking account. Just go get another checking account so you have another debit card, right? And then what are some other things? But before I forget, I want you guys to learn this new game it's not a new game for me over the last couple of years, which I wish I knew a long time ago. It's credit card points. Credit card points are some of the best, like that's what allows me to have all these business expenses that collects a lot of points, and I use those points for personal. traveling.
And
And-
they're still not taxable. So they
And
had a
it's-
ruling, it's still the credit card points, use it. That's what I tell my clients who have a high expense business, my contractors, restaurant owners, hey, use your credit card while using your debit card, use your credit card. Oh, I don't like having bills. Look, through the phone, just pay daily if you want, who cares, right? But you get your points and then you travel with that. You know, that's,
And it's a new habit that you have to form, just like, you know, something that's new, right? So we have this checking account, we have this debit card. Like, don't even look at that debit card. Like, get a credit card that has points and just use that credit card, and then just know that you have to pay that credit card off every single month. But it's the same thing. Like, you just treat it as it's your cash and your debit card. And all you're doing is just like, you get an Amex or you get a Chase or whatever, you know, I'll give you a link so I could get some extra points. I used his link so he could get points. So this is
because I love my Amex. I love my Amex. Who uses their debit card all the time? Perfect. You? I was in banking for the longest. I used to hate the debit card because it links right back to your checking account. Anytime there's fraud, they mess with your regular account. It could be a nightmare. While if it's your credit card, just call them. There's no issues. Your cash that you have to pay your bills is always safe. That's why I love the credit card. But again, the responsibility of it, hey, I literally, every week I'm just doing transfers of payments into my credit card because that's what it should be, you know, this way I don't get a big bill at the end of the month because the money's there. It's just, I personally prefer to use my credit cards, specifically for that reason. I went to Miami once, I paid for gas. All of a sudden, I got an alert. Another time, Miami again, paid for dinner. Someone was trying to buy a MacBook Pro at like 3 a.m. or something, but it was with my credit card. So I was like, all right, just cancel it and send me another one. If it was my regular checking account on a $2,500 MacBook Pro, then your money's frozen and then you don't have access to it until it gets resolved. That's my banking days. I was in the banking world. That's why, hey, I use a credit card. Second is always like the points, but B, responsibility of it, just make sure you transfer your funds over on a regular basis. You don't have to wait till the end of the month. You don't have to wait for the bill. Just transfer it over. If it's in your checking account, it should be important to just transfer it over. The less you see the money in your account, the less you know it's yours.
Yeah, so I use a credit card for points too, but just to clarify, when it comes to like, you know, your commission coming in, separate between your personal and your business checking, right?
Correct. That's your commission. So that's your business income. Now, depends on your structure. If you're just a DBA, it's just me doing business hours, I get my commission to my name. The separation helps on the expenses. The income at the end of the year will still be you know. Then when you go into a company, a corporation, then you definitely, there's rules that they have. If you're a corporation, you must keep proper books and records. So every time I go through an audit, the IRS agent has a checklist. If it's my client, I get graded on how I prepared the return. If it's not my client, first thing I say is like, hey, full disclosure, this was not my client. They found me to represent them. So whatever's wrong here, don't grade me on it because they literally grade me as a preparer. And I'm 100% upfront and be like, hey, that wasn't my client, or I didn't prepare this. I'm just representing the client. And then they give the preparer a grade. If I get a lot of fails and make it say, hey, you're not doing a good job, maybe we should start looking at your own tax returns. So.
To clarify, you're saying at the second tier is when you probably want to do like a second account with like a business name?
No, first tier, right away. Just get used to it. Good habits. Good habits, right?
Yeah, first year get a checking, just open up a checking account, and then you open up a credit card and just use those only for expenses, and that's it. And then even you have the commissions going into that account as well. So you have all your commissions going into that account and all your expenses are going out.
And then but your net, that one there is a little, I get the mindset, hey, it's my business, yeah, but at that point you are the business, so they don't differentiate between your profit, it's all yours, you know, but it helps with expenses part. Hey, transfer, I don't know, out of your commissions, three grand, you know, on your personal side to cover your personal expenses. Hey, I paid my PG&E bill, I paid this, I paid that, because then that's not a business expense. Back to the bookkeeping. At the end of the day, you're still gonna pay the taxes over it. Then when you get on the corporation side, then you definitely have to keep a good separation of everything. I've seen bad ones, really bad, where I'm like, I can't do this tax return for you. Like, why not? You're paying your mortgage to your corporation and you're telling me it's a business expense and I'm telling you it's not, but the company pays for it. Oh my goodness, I understand the company pays for your personal mortgage. And it was just a couple, they're like, oh yeah, we made X amount, but we're only net 20. Like, doesn't add up. I'm telling you, you're gonna go through a hard audit, and if I prepare this, you're just gonna make me look bad. You know, like, sorry, I'm definitely not rude. If anyone knows me, I'm not a serious person. Life is too short for that. I crack jokes a lot. Sometimes life is too tense. You guys deal with a lot. Phone calls every day, so do I. You know, life goes on. Whatever happened yesterday happened yesterday. That should be business 101. You missed the sale yesterday, look for the next sale tomorrow. But I'm always looking forward. That's just me personally.
What's the percent of when the income does come into you that you set aside for taxes? Once you make like that tier of year?
Sometimes you're almost at 30%. And this is where now we talk about tax planning. How can I get you below 30? Because we live in a great state of California. It pays a lot in taxes, right? I mean, right? Across the bridge, that's a tax. The car registration doesn't stop. Sales tax. I hate looking at my receipts sometimes. All right, I mean, it's depressing, but yeah, so we got to pay our federal taxes, then our state taxes, self-employed, and you got to pay your self-employment tax. You guys are familiar with self-employment taxes? No? No? Get ready. Self-employment taxes. I'm assuming you worked at a different company before this? Where'd you work at? Before that. Anything like on the W-2 side?
Yes, yes.
Where at?
It's Samaritan House.
Samaritan House. So you got your paycheck?
Yeah.
Taxes withheld. Through it, you have Social Security and Medicare tax. You're now subject to pay your own Social Security and Medicare tax, which you won't have in the future, but that's a different story, right? But you got to pay your self-employment tax, which are Social Security and Medicare tax is 15.3%. So automatically, sometimes why tax so high? I'm like, in my head, I'm already factoring in your self-employment tax. If you tell me I netted 100, I'm like, okay, that's 15 grand there. Then I got to factor in what your federal tax rate's going to be. It should be at a 22. That's 22. That's 37%. Then your state, another 8. Yeah, you know, 45% just in taxes alone. Then like, dude, that's too high. Let me save you some money. Yes. Yes.
I have a few questions, but I'll ask Lily. So we're married, and he has a W-2 and a 1099. Like, and is that is still that bracket that you're talking about? Is that the 70, 100? Is it the same bracket?
Correct, because it goes into the same household, same tax return. That's a really good question. Now, whatever he does and you do affect each other. I'll give you a scenario. I have a couple. One spouse or significant other makes $150 a year, as an example. So that already puts them at a certain tax bracket. Whatever the other person makes gets taxed at their rate. So just keep that in mind. So when I have a couple, one has a small business, I tell the other couple, hey, go single zero. They're like, why? I'm gonna pay a lot in taxes. Does it, I mean, if you're combined, you know, if you're a good couple, then it wouldn't matter because the money goes in the same pot. If not, then that's a different story. But hey, at the end of the year, you're just going to pay more at the end of the year. Just have yours taxed more to offset this additional income that comes in. You know, so I try to tell that to my couples. You know, if one is working, I go single zero. You know, whoever is working. Because hey, if I'm going to net 40 grand here, how much is 40 grand going to cost you in taxes? If the other person is already making 150, you're going to be at 190. That should be at a 24%. That means your 50 is going to get taxed at 24% plus your self-employment tax. That's just my advice that I give on the W-2 side. I try to explain it as well as I can. I try to simplify taxes. If I can do that and just simplify it for you guys, then I've done my job. I don't use big words, nothing like that. Just keep it simple.
So is it like the first step would be like a consultation with you, like versus like, hey, here's all my taxes, come help me. Like, do you recommend doing like a consultation with you first?
Yes, this is your consultation. No, think about it. I mean, I have people who, hey, I need a consultation. Everything that I'm going with you guys is what I go with a client, literally, and I bill for it. Like, Hey, I tell them, hey, you want a consultation? I bill for it. The reason I did that was a couple years ago. I went to a seminar, and they said if you do that, it'll weed out anyone who's just a looky-look.
Yeah.
I mean, then it tells me, hey, this person is serious. That means I'm gonna have a client, me personally. But I tell people, this is honestly, like this is a consultation as a group. If you guys learned anything today, trust me, this is a consultation. You guys are getting free tax advice. Come to me, don't come to me. I want to see you guys successful. If you guys are successful, that means he's successful, and that means he keeps me. That's all that means. It's how it works, right? If he's not successful, he's like, Mauricio, I don't need you anymore. Sorry, bud. I'm closing up shop. I lost a client. But no, all your success here, just you guys should all be in it together. Hopefully that makes sense.
Yeah. Can you talk about the two? So there's two things that I learned that I didn't know when, after finding you, right? Whereas putting taxes in these accounts, right? The IRAs and then the HSE accounts. So like if you have a big tax bill that's due, you could put money into these accounts. Can you talk about that a little bit?
Who has?
'Cause I think that's huge for you guys to like learn. Because like let's say, well, you will be having, you're going to be at $150,000, $200,000 this year, right? And like you're going to have a tax bill, 30% of that. So what do you do with that extra? So then
Let's talk about now retirement accounts, right? Because that's then the next phase is, hey, I'm done here, I'm up here, I'm making X amount. How can I lower my taxes? There is the self-employment pension, the SEP plan, which it's better than the IRA. If you have an IRA, that's great, but the SEP lets you contribute more. So I always recommend the SEP instead. There's the HSA account. I actually love the HSA account. You get a deduction. Okay, now if you're paying for your own health insurance, so you get a deduction for the HSA account. You then can use that money to pay for your health insurance, which then your health insurance is a deduction as well. It's free money. I call that free money. If you want, you can bank that HSA account until you retire, whenever the case may be, and use that to pay for medical expenses tax-free. So it just keeps growing for you if you do it right. HSA is a good account to have. Then you have your IRAs and your Roth. Nothing wrong with either one. The SEP is just a little bit better, meaning you contribute more. So if I have my middle or my higher and I'm like, hey, the 6,000, whatever the IRA is right now isn't enough, what can I do? You can set up a SEP account. There's also called the 401k plan, which is a 401k for self-employed. You can put the max, which I think is like 22,000. So hey, I made 100, put 22 in there, just saved you X amount in taxes. Just by telling you to do that.
So instead of paying Uncle Sam that $22,000, now you're moving that into another account that basically it's just your retirement.
5 years later, you have 100 something in that account. You can roll that into a self-directed IRA. This is like higher up there. This is for my upper people. Your self-directed IRA, because then you can use that money to actually purchase real estate with and not pay taxes. I have a broker who I know. The dude is like, man, he has his SEP and he uses that to buy and sell homes and he doesn't pay taxes over it. That's when you're on top, like X amount you're making because you're contributing so much into your account that you then can use it to invest. You can invest in whatever you want. You can, if it's your account, you can let me borrow the money to buy a car as long as I'm paying you interest. That account is a really cool product.
It's just like you got this balance due, right? Like that's where you're trying to see like what to do with that. And that's where it's like all these little things add up to
November,
a nice amount to where instead of having to pay that, like you could just put that to these other things that benefit you way more.
Literally, all you're doing is just paying yourself.
Assuming that's what you would want to do after you've already decided what you're going to owe.
That's where your November, December planning comes in. Like, hey, I'm in a net this year, dude, I had a great year. You started off slow, the next thing you know, summer came in, oh my goodness, okay, what am I gonna net? And you're looking through your one bank account that we have, your one credit card, you've come up with your expenses, good guesstimate, I call it. Hey, I'm gonna net like 180 this year. You say, okay, let's lower it, let's break it down, let's set up the SEP account, let's do this, let's do that. Hey, I did want that new vehicle, okay, so you start chopping it down to lower your taxes. And then it's like, hey, for next year, starting January 1st, let's start up that corporation because you're no longer gonna be at this one tier. Let's start the corporation because then that also adds tax savings. That, you know, it just depends on where you're at. But that knowing ahead of time, it's so helpful. Back to like your record keeping, your books. It's not for me at the end of the year, it is, but at the same time, it's for you. You got to know where you're at, right? How much did you make in November? Well, I don't know. And you're not helping yourself, literally, because then you just come in, 1099 get issued to you. I made X amount, I can't believe it. I get that all the time. That's no way, that's not true. All right, look, go talk to whoever issued it to you and then let me know when you're ready. Okay, it's correct. It's when the money comes in, you just don't see it, right? Everyone can agree? Because we start spending, normal. And so then your records or your keeping track really helps. That's really helpful for you guys. It lets you know where you're at, helps you on forecasting, what to do. Back to like I'm spending too much money on clients but not getting nothing back. I'm doing something wrong. What am I doing wrong? Where is my money better spent at that gets me something back? Your rate of return on your investment. What should I be spending money on? What should I be doing? What am I not doing right? Something's off here. I'm not generating the sales. Boom. Hey, did you follow these steps? Did you do this? Did you do that? No, I missed these couple steps. Well, go back to the formula. He's got a simple formula. I love his formula. I tell you, I know a couple guys that are very successful already, followed the formula. They're killing it now. And then, so he's got the formula. Secret sauce. Easy peasy.
Do you know much about, like, me and Erica have a client and she's 55, or she's older than 55?
Repeat that again?
Me and Erica have a client and she's older than 55 and she's curious about, like, transferring your taxes from your current property to the new one that you're going to buy. Do you know much about that?
You're lucky because I have experience. Yeah, that's going to be a title question, but you have to buy at the same price. The only reason I have experience because of my mom. When she retired, she wanted to sell her home, so I had to find all that out from mom. So all my life, all I have to do is read a lot. Anytime I have a problem, I have to go and read my tax book. So then started researching on it. You just have to buy for the same price. So if you sell for $500,000, you can't say, oh, I'm going to buy for $600,000. It has to be for the same equal price or lower. That was put into place when you want to downsize your home, not upgrade your home. I am now 65. My kids are grown. I had the big Hercules home. It's vacant now. Let me get something smaller. I don't want to go up the stairs. I sell my house for $800,000. I then move somewhere smaller and buy for $400,000. So instead of paying tax over your $400,000, your tax rate, hopefully everyone follows me here, it follows you where you originally purchased your home. If you purchased for $100,000, they'll transfer that $100K balance to the new home. That's very key for anyone 55 and older.
And you can purchase before you sell as long as within the 2 years, right?
That one, I'm not sure about that. That one, again, that would be a more of a title. Everything in taxes, I get it asked, but that's a title question or reading, because I know if within the county is fine. If you go into a different county, you have to do something or apply. See, there's.
You have to see if they accept it.
Yeah, you have to see if they accept it. There's certain rules in different counties on how that would work. So the more you get informed in it, the better you are as a realtor for the future. Like seriously, like the more scenarios you get, the better you are. I've been thrown so many scenarios that all this I just have in my head already.
Let's say they did end up upgrading or buying a house, even though they downsize it, but it is cost more than what they're selling. What's the penalty?
No penalty, you just don't qualify.
You just don't qualify
for the lower tax rate. You just pay the regular taxes over it. I think your 2 year comes after you sell. They give you 2 years to purchase, so they can sit on the sidelines and wait, and then they have 2 years. Now, because I had to research that from my mom, but she thought prices were going to come down. They didn't, so she ended up staying in Nicaragua. She literally sold her house here. Says, "Mijo, I want to sell a house." Like, why? Oh, because it's good money right now. Like, and like you need a place to live. Oh, because her dream was always to go back home and take care of her mom for a good 6 months to a year. And she said, "I'll sell it, and then when the prices come back down, I'll move back." Never came down. I'm like, "Mom, bad news. 2 years passed, things ain't coming down." So we found her a house out there.
Would you recommend that for a client that is 55 and older, should they speak with their tax consultant first before making the move, or what are the steps?
For that, hopefully the tax person knows what they're talking about. So I run into a lot of issues where I get the phone calls from someone else, and I'm like, "Why are you asking me? Ask your tax guy." I'm not trying to be rude. I'm just because this is not even this is not a federal tax, a state tax. This has to go with the county. And then the problem there is like Daisy knows, hey, what county are you moving into? So sometimes the realtor has to do the research there, like to help the client decide, like, hey, if we sell your house here and you're talking about moving from Contra Costa to Solano County to Sacramento County, is it going to be allowed or not? Because then you have to then check those counties. So that's a big problem there, because easily you can refer everything back to the tax person, but are you really doing your client a service? Because that's not even on our realm. Most tax guys don't even know about that. The only reason, like I said, from experience, my mom, I have a couple senior clients, and they'll ask me. So I did the research myself, just to find out. Then I can call Daisy, like, Daisy, I got a question, you know. So we can go back and forth with each other. That's you got to research that one and find out, hey, what county do you want to move into, and then give them like, okay, if we sell here, these are your restrictions, what you can and can't do, and then ultimately they can decide.
One thing to remember, you're learning a lot from taxes. You guys are reading on taxes. You guys can never give tax advice to any of your clients. Like, that is like the number one thing to not do. So people are gonna be like, oh, well, what do you think I should do on my taxes? What do you think about this? You know, like you always gotta say, look, hey, I legally can't give you guys tax advice, but I got somebody, and then you could refer people over. But like, that's definitely a huge thing, because like, you guys get tax advice and you don't do the right advice, and it's just not good.
I can't give real estate advice. I'm like, look, talk to your real estate agent.
Your license is not a tax person.
I can look up this. On the county one, I don't think that's a tax question. That's just like the county rules. But hey, how much am I going to pay in taxes? I don't know. If I sell my home, go talk to your tax guy, because then we have to do this whole calculation to figure out what the tax would be for a client when they sell a home. We can exclude some of the sell. I have formulas. I had a client who was given bad advice by her realtor. She said, sell the home. And then she came to me, she was like, I sold my home. I'm like, great. Then I'm doing like, wait. When did you sell? She goes, oh, this date. She wasn't meeting her 2-year rule. Everyone's familiar with the 2-year rule? Real estate 101, living in your home for more than 2 years, you can exclude $250,000 from the sale. If you're married, $500,000. She wasn't meeting that. She was going to get a big tax bill. Lucky for her, I swear, true story, I had just taken a course on how to help clients with that. So I went through this whole long formula for her, saved her all the taxes due. She was so thankful. She wrote me a postcard, and she's my client for life. She's like, here's, she said, I think, no, she had to move out of state because she married a Marine. But she's like, Mauricio, if I come back, you're my guy. Literally, it was just bad advice from the realtor. And I think on that part, it was just trying to make a sale. I'm like, dude, I think she would have still sold the property. It was just, you would have waited 3 more months. You would have saved the client all this headache, save me a headache, and then I wouldn't have to bill the client as much.
Cool.
More questions?
I think that was some good stuff.
How much do you charge for your consultation?
$200. If you want to open a corporation, I apply it towards it. Like I said from the beginning, honestly, it's just to weed people out. Because a lot of times, when I first started, I would get a lot of phone calls, people just asking questions, and then I didn't see them come in. And I'm like, what am I doing wrong here, All right, and then it's like, okay, and then as soon as I applied the consultation fee, then those questions are no longer A, asked, or B, if it is, it's a qualified client. Back to, right, everyone runs a business, I run a business, it's now going to be a good client. I even tell them, if you want to go into opening a corporation LLC, I'll apply it towards it. I just know that you're now serious coming through the door. I learned that a while ago. Once you charge a fee and someone pays for it, they're more likely to show up. Right? Hey, if I paid you to do something, I don't want to lose my money, let me go. Compared to, oh, I got you on my calendar here at 1, I'm over there waiting. And we're going to be there at 3. I'm like, okay, great, I got nothing else to do. Let me just wait till 3 now. So when I did that, it kept everything a little bit more in order for me. So just let your clients know, hey, yeah, he'll charge you a fee, worth it, not worth it. I think it is. Right now, you're going to have an issue on finding qualified CPAs and enrolled agents who want to help people. They're changing their business model, and they're going into a monthly subscription. I don't know if you guys have ran into that yet. If anyone's tried to find a tax person or tax guy, tax woman, tax person, CPA, I'm an enrolled agent, whatever the case may be. All my CPA friends have gone to a subscription base, meaning if they're not going to make X amount of you, they're not even going to look at you. the reason why is just on the business side of things, you have TurboTax, H&R Block Online. So those have taken away the simple ones, you know. So now it's like, okay, what I do, okay, who am I going to focus on? So they try to go in for the more business clients who don't mind paying that fee. Just to let you guys know, then my space and what's going on there. We had a big issue with COVID. When COVID came about, a lot of people retired, a lot of people passed away. I don't know what to think sometimes. Oh, I found you because my guy died. I'm like, great, is this where I'm gonna die at? Oh my God, it worries me because that's what's happening. And then I have CPA friends, and they actually call me a lot of the times for answers because they're CPAs, like he said, they went to school, but then it's the real life experience, you know, like, hey, what have you done for a client so far? I've gone state audits, IRS audits, sales tax audits, you name it. So I have that real life experience to then be able to tell you guys, hey, this is what they look for, this is how you want to do it, you know. That's where I come into play, is like, hey, the experience side of things. Yes?
So if you're filing jointly and you know you're going to be over 250,000
Combined?
But you're newer to real estate sales, do you recommend opening an S corp now?
No.
Or waiting?
So first look at you individually before you do that, you know, because if it's combined with you and your spouse, then he's going to pay X amount of taxes automatically. Just keep in mind that whatever you net is going to get taxed at a higher rate, you know. I always tell, just keep that in mind. Hopefully you guys are on the same page. If you're on the same page, it makes life easy. I do have, you know, the couples who disagree, and then it's like it's a little argument. I'm like, you guys figure it out and let me know what you want to do. That's up to you guys. You can do married filing separately, whatever you want to do. It's not the best filing option, but no, it's not that. You want to look at yourself individually, 70K and above, and then that's what you're looking at. Netting. I say netting, not the, hey, I made 70K. Just with your business mileage and expenses, I can drop you down to 20. Well, you give me a car in there, I can drop you down to 0. That's a free car. Let him use it, it's free. Hey, he's happy, you're happy, I'm happy, we're all happy.
And it has to be a new car that you purchase, like.
It does not have to be a new car.
It can be my current car?
No, it cannot be your current car. Now, you can't just say I purchased my current. Now, if you want to go buy a used car off the lot, then you can buy a used car off the lot, but not say I'm buying my current car from who? For myself.
Sell it to me. Yeah, and then purchase it again.
I had a client who were doing their stuff, and they're like, hey, what's this fee here that we see you paid for IT services? Did you tell that person? Who is this IT person? You paid them $3,800. Me. Oh my God. So no, you can't. Who'd you buy the car for? Me. Used car will work. New car also.
Yeah. But it has to be a new purchased vehicle.
Yes. I had a couple, one realtor, one not. She leased the car and brought it off, and he was using it, so he was happy. You know, I'm serious. It's like, hey, if you can now get away with more things on the business side that you're still going to spend on the personal side, then that's where the business comes into play. Everyone's on social media. That's what they keep preaching online. I'm not a big fan of it. I like to make sure that it's the right fit for the right client. That it's not an one size fits all, you know. That's not the way it works. Everyone's different scenario, everyone's different. So you got to analyze your own scenario to see where you're at and see what makes sense for you. If the higher income, there's certain things you can't do. Certain credits then you're not qualified for, then this is where the conversation piece comes into play. Question, anyone else? Anyone who hasn't asked anything?
Guys, get some value. Now you ready to do your taxes? Get ready to do your taxes after all the money you guys make this year.
Not necessarily related to realtor taxing and whatnot. I was curious, what is the capital gains tax rule when you sell a property?
Easy peasy. Long-term gain, you're 20%, so you got to keep it for 365, 366, you gotta add a day to it, and that's considered long-term. Short-term goes under your regular income. So if you have low income, you'll pay less in taxes. If you have a higher income, then you're just gonna pay at your current tax rate. Now, that income does cause you to go up in the tax bracket. So if you have an investment property, short-term, no other income, 300,000, then you're gonna pay over that 300,000 at the rate. And then we work on a progressive system on X amount gets taxed at this rate, next one, and next one. So it's not like a flat tax rate that you pay on income. It works in little buckets.
Okay.
So
Is there a way to like get around having to pay that tax at all? I don't know if it's, I don't know
Sure.
if it's like, I heard, I don't know, I was talking to my aunt like a couple years ago. She mentioned something about if you sell a house, but you buy another one.
1031 exchange, get familiarized with that. 1031 exchange, 1031 exchange. I like repeating it.
But what if it's your primary home? not-
Doesn't qualify.
Okay.
So 1031 exchange, I like repeating it. I like repeating certain things 3 times. It stays in your head. It only applies to investment properties. If it's your primary home, you already have a 250,000 exclusion embedded into it. If you meet the 2-year rule, okay? So you already have that, so you can't double dip. Now, if it's an investment property, you have to buy at or above. If not, then you're subject to boot, what's called boot, so you're subject to pay part of the taxes on it.
Okay.
So now, if anyone here has a client who's thinking about it, automatically tell the escrow officer because they have to get a 1031 person involved right away. The client, you can't sell the property, the client gets the money and then they decide to buy it and exchange it. I've had that happen, that doesn't count. What do you mean? If there's no 1031 exchange, then it doesn't qualify under the IRS code. It has to be someone else collects the funds and then that person then distributes the fund. You have, 90 days to identify, 90 days to close, I think, the investment property. Now, if it's someone who just bought, never used it as a rental, doesn't qualify, then your 1031 exchange person will give your client all that information, the correct information for them to use.
Okay, so just to be clear, so say for example, maybe you were unmarried, you bought a house, you were living in it, you got married, bought a second house with your spouse, but you still own your personal home that you no longer live in, you're not renting it out for investment purposes or whatever, but you do decide to sell, you don't do a 1031 exchange on that one. That's just a regular.
How long ago have you been living in the other house?
The questions come into that, then the question would be, hey, how long have you lived in the other house? Do you qualify for the 2-year exemption?
Okay.
If you move out of it and move into the next house, then that day that you technically move out, you no longer, the clock stops for you because that's no longer your primary residence. So it's a 2-year rule for your primary residence. Then you can exclude up to 250,000. I bought my home for 250,000. Year 3, it's worth 350. A client comes to me, how much you're going to pay in taxes? I say 0. How do you know? 250 plus 250 is $500,000. You're selling for 350. On my head, I don't even ask any more questions. I keep it so simple. Sell it, no taxes due. Never rented. Nope. Your primary residence for 3 years. Yep. 2-year rules applies. I'm done. I mean, that's how fast I would work in my head. It's like, oh, no, you're good to go. And they say, that's it. 30 seconds. It took me to answer the client's question.
Okay.
Good question.
Cool.
Anyone
Well,
else?
thanks for showing up,
Yeah.
man. Thanks for coming and giving the value that they need.
Thank you guys. Thank you guys for having me.
His cards are there if you guys need them.